This is a brief tutorial as to how to find bond prices for the capital asset. Well, when you do weighted average cost of capital, you may want to see where a bond, or you just may be interested in where a company's bonds are trading and what they're paying for debt. And what I would suggest is going right to the company website, going through their financials, beginning there, looking at the bonds that are available, or going to if big companies like, for instance, Starbucks. I went to a website, I called up Starbucks debt securities. They had a Morningstar, which is very good, Morningstar, and Morningstar comes up with a look at their debt, their preferred, their equity. You have a great graph about what securities they have and when they mature. Looks, they have one bond that goes out to 2045. They have a bunch of debt that's and they use some of this debt to buy back stock, by the way, and that's stuff you should be looking at. But from 2015 to 2028, we have some debt, and the circles represent the size of the debt, so you get an idea of how big the debt offerings were. And then here they give you a tabular form of which debt securities are outstanding, and then a bunch of very helpful credit quality looks and debt to equity ratios, EBITDA to interest ratios. You notice the debt to equity is 0.71 for the firm. Not so bad compared to the industry average. They're actually in the food business. Their quick ratio is here. The debt to asset ratio is up there. So they pretty obviously Starbucks is doing well, but you get to see the amount of debt that's outstanding. And then I kind of zero in on some of it to get an idea. So I looked at the 2045s that pay interest of 4.3%. In my case, I called a friend who has access to immediate market data, and they traded about 85 basis points, or 0.85% over comparable treasuries. And remember, it's the treasury which is the safest borrowing rate. Every corporation will pay some premium over that. It'll be a function of how long they want to borrow money, and it'll be a function of their credit quality. Starbucks has A-rated paper, so they're paying about 85 basis points, or a little less than 1% over what the U.S. Treasury would pay. And this is a very good time to be borrowing money, because in the absolute sense, treasuries are very low. So you're really gaining a great advantage. The long-term treasury trades at a little below 3%. So Starbucks is sourcing capital at 4%. When you take away the tax advantage, never forget that, very important. When you take away the tax advantage for deductions of corporate debt, you're taking about 35 to 40% off the top. So in effect, like a mortgage, Starbucks is sourcing debt at about 2.5 to 2.75%. Now, given that, going back to the Modigliani theory, you would say, Miller theory, you would say, well, then I should only use debt, because it's always going to be the cheapest thing. I get the tax deduction. It's going to be relatively inexpensive to equity, except that too much debt can put other costs and pressures on a firm. So there's a limit to how much leverage we want to place on a firm. We'd rather raise partner capital or equity than switch over to too much debt. So keep in mind. So what I would say again is, whatever company you're looking at, go to their website, look at what debt they have outstanding, then search for it. A lot of information out there. Morningstar does a great job, and that's where you'll get that information. And then finally, I'd go to the Wall Street Journal website and go to the bond market column, go to markets, go to bonds. They're going to give you the 10-year yield is falling. We took this on June 15th. There's your treasury curve. There are the treasuries. Notice the 30-year bond, I told you, just under 3, 2.78. The 10-year bond is 2.15%. The government's borrowing 5-year money at 1.78%. So you get a good idea where the lowest yields are per period. And then there are all and you should pay close attention to this, there are all the consumer rates: prime rate, money market rate, 5-year CD, 30-year mortgage. You shouldn't go out and take out a mortgage or buy a new car without checking these rates first. Home equity loans are at 4.98. This is where it begins. There's the global markets. This is something you should commit to memory or be checking a lot. There's your economic calendar, a wealth of information, and relatively free, although I'm a believer in subscribing and reading the Wall Street Journal every day. There's all your news. And I believe you could probably find, down here, you could find bond yields or corporate. So let's hit that for a minute. And there's an example of different bonds and where they're trading. And you can get an idea based on their rating where your bond would trade. Notice JP Morgan 7s of 49, which goes out of ways. There's 56 over the Treasury. Barclays 6 and 5/8 of 49. Now they trade a much bigger spread over Treasuries given the issues in Europe. Deutsche Bank 4% over Treasuries. They have their own issues. Now you could start to correlate yield spreads with the actual stories of the companies. But those are actual gainers, and then you have decliners. There's Murphy Oil. A lot of the oil companies have look like they're doing poorly today, and that probably indicates more problems in the oil patch. But notice the Hess 5.6 is a 41, almost 3% over Treasury bonds. So if you're looking for more yield, this may be a place to start. Obviously, for the average investor, it pays to buy a fund because that's usually the way to go. So this is where I would begin my look for. This is where I would begin my look for corporate bonds, ratings, that sort of thing, because I think this is where you're going to find a lot of information on bonds, and then you can drive down to your bond. There's a credit derivative market, there's bond yields. Let's look at bond yields real quick before we finish our tutorial. And there you go. There's Treasury rates once again, previous prices, yields. A lot of stuff here, more than I can cover in this video. But you should definitely go in the Market Data Center for the Wall Street Journal and spend a lot of time with it, because there's a wealth of information that no serious business person should be without.